14.23% distribution rate per June 30th, 2026, and 21.98% total return since inception from CAIE, also known as KAI, the first autocallable income ETF in the U.S. retail market. Is it too good to be true? How does KAI generate its potentially high and stable monthly income? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. Now, as the regulars on our channel know, autocallables are not a new invention. They've been around since the early 2000s in Europe and Asia as a popular instrument for income-seeking investors, and are also a well-established $100+ billion asset class in the US. However, in our country, they have traditionally been offered mainly to high net worth and ultra high net worth investors in the form of unlisted notes that are not liquid. When KAI launched in 2025, it was the first ETF to make autocallables liquid, meaning everyone could now buy and sell it as easily as any other share via their broker. Calamos formulates the sales pitch for autocallables as follows. Think of it like a bond whose income and principal depend on the stock market not falling too far. This naturally piqued the interest of quite a few of you in our fixed income community who have already built out the guaranteed lifetime income streams in the base part of your portfolio via annuities, treasuries, and similarly safe bonds, and are now looking to take on some controlled risk for potentially higher returns in the boost part of your portfolio. So, with that in mind, here are the 3 topics I'll be covering today. 1. How did KAI's first year on the market go? And what would the return have been for an investor who bought KAI right when it was first launched? 2. How does KAI generate its distributions? This is one section you won't want to miss if you're seriously interested in the income potential of KAI's autocallable strategy and want to understand where the cash comes from and what the underlying risks are. And 3. Why might tax-conscious investors be interested in KAI? Now, if at any point in today's discussion you want a deeper dive into KAI, how autocallables work, and where their potential downsides are, for example, when coupon payments might not be paid and when there may be a loss of principal, please check out this deep dive on KAI that we did in June together with Calamos. Link below for your convenience. The position of an autocallable investor is often described as that of an insurer against a steep and potentially long-lasting market downturn, which is not for everyone. Let's dive in now, folks. How did KAI's first year on the market go? And what would the return have been for an investor who bought KAI right when it was first launched? KAI, the Calamos Autocallable Income ETF, has built an attractive track record since it was launched in June 2025. And we actually did our very first video on KAI on this channel almost exactly a year ago as well, just a month after its launch, at the request of some of our VIP Investment Club members. So, let's see how things went up to the time of this taping. Please note that unless otherwise stated, all the numbers and screenshots in this video are as per July 20th, 2026. KAI has paid a dividend of more than 30 cents per share every month since August 2025. And if we take KAI's last dividend from June 30th, 2026, annualize it, and express it as a percentage of the fund's price per share at the end of the observation period, we get to this cash distribution yield of 14.23% that Calamos shows on its website. If we had to guess, we would say that early investors in KAI would probably not have been disappointed so far if they were looking for high, stable monthly income. But dividends are only one side of the story. Capital gains and losses, whether the share price of an investment goes up or down, matters as well. And here, if anything, the track record of KAI is even stronger. Morningstar shows a trailing total return of 21.98% as the earliest available number. In other words, this 21.98%, that's the annualized return investors would have made from both dividend payments and share price gains had they bought shares in KAI right when it was first launched. But past performance is no guarantee of future results or outcomes, and some may even think that these numbers may sound too good to be true and want to understand where the risks are. After all, one of the iron rules of finance is higher risk, higher return, which brings us nicely to the next part of today's discussion. How does KAI generate its distributions? So KAI, the Calamos Autocallable Income ETF, seeks to generate high monthly income through exposure to a portfolio of autocallables. KAI does not own any autocallables directly, however, but uses derivatives like swaps to build its exposure. The process is complex, but ultimately aims to deliver the coupons and market values of the underlying autocallables to the ETF and ultimately to the investor. We'll discuss how that works in a bit more detail later. So one of the key numbers to understand for potential investors is this 14%, the weighted average coupon of all autocallables in the Mercube Autocallable Index as of the last observation date. So this 14% weighted average coupon is exactly where it was right after KAI's launch last June, despite some slight movements through the year. And in our mind, it remains attractive in today's environment. Let's dive deeper now to see where this 14% weighted average coupon of KAI's underlying index, the Mercube Autocallable Index, comes from. We'll simplify it a bit here, but in principle, the 14% weighted average coupon that KAI's underlying index shows currently is made up of three key components. Let's assume that we're working with a par value of $100 for this illustration. The first part comes from what we refer to as the autocallable premium for the market risk that you take. Basically, it's compensation for the fact that your coupon and principal repayment depend on how the market does. The autocallable premium is calculated based on options pricing theory. More on this shortly. In this illustration, the autocallable premium makes up about 6.35 percentage points of this 14% weighted average coupon that KAI's underlying index shows. Moving on now to the second part, which is a decrement applied by KAI's reference index, the Mercube US Large Cap Vol or Volatility Advantage Index, abbreviated MQUS LVA. Decrement is just a technical or fancy way of saying a deduction from the index. This decrement makes up about 6 percentage points of this 14% of the weighted average coupon. So 6.35% from the autocallable premium plus 6% from the decrement on the MQUS LVA gets us to about 12.35 percentage points of this 14% here. Which means that the third part is about 1.65% to get us to this 14% here. This third part is basically the interest earned on the collateral for the derivative that underlies KAI. We'll talk more about where this third part comes from later also. For now though, let's focus on the autocallable premium in the first box. And to do so, we need to go to this coupon and autocallable chart from our previous KAI deep dive. Recall from that video that this green line is the Mercube US Large Cap Full Advantage Index, or MQUS LVA, the reference index that KAI uses. The MQUS LVA is ultimately based on the S&P 500, and as most investors know well, the S&P can be quite volatile on any given day, week, or month. So, how is it that KAI can seek high stable monthly income when it's exposed to the S&P 500's constant ups and downs? Well, the answer is that while the reference index, the MQUS LVA, uses the S&P 500, the E-mini S&P 500 futures contract to be precise, as its starting point, it makes two modifications to help smooth out the ups and downs in order to seek high stable monthly income. The first modification is that the MQUS LVA has a fixed volatility target of 35%. In other words, the likelihood that the index will move by 35%, either up or down, should always be 68%, or one standard deviation on an annualized basis. And this is important because managing the volatility helps to keep the autocallable premium more stable. This illustrative 6.35% from earlier. Let's talk through this a bit because it's not always straightforward. Recall from the previous section that the position of an autocallable investor is often described as that of an insurer against a steep and potentially long-lasting market downturn. Or put another way, if you were pessimistic about the market and you did believe that a black swan event was lurking around the corner, so to speak, you probably wouldn't want to insure someone else against it in the first place. This position of a fundamentally optimistic insurer is basically that of the seller of a long-dated put option in market terminology, and that's why this autocallable premium can be calculated using options pricing formulas. And volatility is one of the main drivers in options pricing theory. So all else being equal, when the S&P 500 is super volatile, options prices generally go up, meaning that this autocallable premium that you receive may also likely go up. And when the S&P 500 goes through more quiet, stable patches, options prices generally go down, meaning that this autocallable premium that you receive may also likely go down. Now, historically, the volatility of the S&P has fluctuated quite wildly. The long-term average is in the 15 to 18% range, but it has seen peaks in the 70s and higher during acute market stress, and lows in the 10s when the future looked just golden. Setting the reference index at a fixed volatility target of 35% helps to keep this autocallable premium more stable, because what happens is that during good times, when volatility is low and options prices are low, meaning autocallable premiums are also low, leverage may be used to take on more risk, to buy more options, so to speak, to get to this illustrative autocallable premium target of 6.35% here. This MQUS LVA essentially allows for up to 5 times leverage in good or quiet times. At the time of this taping on July 20th, 2026, the leverage level stands at a bit more than 2.1, so a bit higher than its long-term historical average of 1.8 to 2. During bad times, when volatility is high and options prices are high, meaning autocallable premiums are also high, leverage may not be needed to get to a stable premium for every new autocallable, and may even be reduced to zero. So, to recap, that was the first modification that the MQUS LVA as a reference index makes to the S&P 500 index. It has a fixed volatility target of 35% that it manages against, basically by adding or taking away leverage, in order to keep this illustrative autocallable premium target of 6.35% here more or less stable. The second modification that the MQUS LVA makes is a decrement, this second box here. As Mercube says, a 6% per annum index deduction is applied daily to the index return, which equates to about 1.6 basis points per day. So, this 6% per annum index deduction basically aims to convert the prospective long-term gains on the S&P 500 into payouts in order to seek regular, stable monthly income. Meaning that from an economic perspective, the decrement has the same effect as if you were selling 6% of the S&P assets in your portfolio every year and paying yourself the resulting cash to get to a higher income. This is not a cost of the ETF. Now, because the underlying index tracks the S&P 500's equity risk at its core, the hope is that the markets would, on average, produce a 6% return every year. So in the long run, you would essentially convert the market gains into cash payouts, but keep your initial investment stable. So let's see how that might have worked out historically. This chart illustrates backtesting for the performance of KAI's underlying index, the Mercube US Large Cap Full Advantage Autocallable Index, or Autocallable Index, over 20 years, from 2005 to 2025. Remember, this underlying index packages at least 52 individual autocallables into one trade, so to speak, and is the mechanism that KAI uses to get its exposure to autocallables. So in this illustrative example, the orange line here basically shows the price of the autocallable index, if you want, the closest equivalent of its share price if an index had one. And you can see that it stayed roughly stable. The gray line up here shows the total return of the autocallable index, how the index might have developed for an investor who would have immediately reinvested all cash distributions in the index, so to speak. And this space here that's in between the orange line here, again, basically the price of the autocallable index, and the light gray line here, its total return. This difference represents the cash payouts that you might have received as part of the total performance. You can also see that the total return of the autocallable index would have tracked the total returns of the S&P 500, the blue line, quite closely. This illustrates one of the main arguments for KAI's underlying index. It would have distributed or paid out a large proportion of its gains in cash to investors in line with its aim of seeking high and stable income. But it would have historically have produced almost the same total return as the S&P 500 while keeping its price roughly stable, which might not be a bad outcome if you're seeking income but are less concerned about capital growth. Keep in mind that the performance shown is that of the Mercube index, not KAI. Investors cannot invest directly into an index. Plus, as always, past performance is no predictor of future results or outcomes. But let's go back to our illustration. There were also times when the gray line for the autocallable index's total performance would have diverged notably from the blue line, the total return on the S&P 500. This goes back to the two modifications that Mercube applies in its index versus the S&P 500, as we just discussed. The use of leverage in particular means that during some periods, the autocallable index might have shown higher total returns than the S&P 500, while during other periods, it was the other way around, and the total return of the autocallable index might have fallen more than the S&P 500. And the individual autocallables that are packaged up in the autocallable index, so to speak, may have broken the barriers a bit earlier or a bit later than the S&P 500 itself, depending on the exact leverage and circumstances, which may be hard to predict in real time for the average investor. But remember, the fact that the overall autocallable index provides laddered exposure to at least 52 individual autocallables in weekly intervals allows for some time-based diversification in its portfolio, as we discussed before, at least so long as downturns don't last too long, which brings us to the next point. As we said before, KAI doesn't really own 52 or more autocallables, but trades one single index, the Mercube US Large Cap Vol Advantage Autocallable Index, which packages all the underlying autocallables into one single instrument. One trade is just much easier to manage than 52 or more individual laddered positions, as the advanced investors and advisors in our community who manage just a handful of autocallable notes can attest to. So far, so good. But as we also mentioned before, KAI doesn't invest in the overall index directly either. Rather, it trades it in the form of derivatives, mostly a total return swap, with JP Morgan as the only counterparty. This derivative structure is the reason that KAI has to hold collateral against its potential obligations from the swap, and also why it earns a bit of interest on that collateral. That's this illustrative 1.65% here, the third key component that makes up the weighted average coupon that we discussed earlier. And if you're interested in taking on some more controlled risk for potentially higher returns in the boost part of your portfolio, come on over and join our growing member community in our VIP investment club, where these conversations happen almost daily. Visit our website at www.diamondnestegg.com and click on this yellow private VIP investment club button to learn more and join us today. I've linked everything below for you as well. So, now that we understand where KAI's distributions ultimately come from, autocallable premiums for the risk you take as an insurer against a steep and long-lasting fall in the stock market, decrements as a payout from the underlying stock market index, and interest on collateral holdings. I should mention one more key argument for tax-conscious investors. The total return swap with JP Morgan is structured in a way that it potentially delivers most of the gains from the autocallable strategy as return of capital, bringing us nicely to the next part of today's discussion. Why might tax-conscious investors be interested in KAI? So, in 2025, 88% of KAI's coupons were paid out as potentially tax-deferred return of capital. Essentially, they may have come tax-free when paid to you. Only the interest on the collateral that KAI held may have been subject to ordinary income tax. Do note, however, that the return of capital counts against your cost base. And when you ultimately sell your KAI shares, you'll be taxed on all capital gains. But if you hold your position long enough, it may be at the more advantageous long-term capital gains tax rates. This is a clear advantage versus a direct autocallable whose coupon payments may mostly be taxed as ordinary income when paid. Please remember that we are not tax advisors, so do consult with your trusted tax advisor to see how KAI's potential tax efficiency may impact your personal situation. In addition, return of capital and options premiums are generally not included as part of the SEC yield calculation. So any 30-day SEC yield numbers that you see may be significantly lower than the weighted average coupon for the underlying Mercube autocallable index and or the distribution rates for KAI that we've been discussing in this video, as those numbers include all distributions, including return of capital and options premiums, unlike the SEC calculation. So KAI is clearly complex, and it does take a fair bit of time and effort to understand the whole construct. But as I mentioned at the very beginning of this video, while autocallables are not for everyone, for the right investor or advisor, KAI can be an investment that seeks high, stable monthly income along with liquidity, tax efficiency, and likely less administrative hassle than plain vanilla autocallable notes. Check out our KAI deep dive from last month that we did together with Calamos. Again, link below this video if at this point you're wondering what our personal opinion on this autocallable ETF is and how you might go about considering whether to add it to your personal portfolio or not. As I said before, autocallables are not for everyone. You essentially become an insurer against a steep market downturn. Your payments are not guaranteed, and you might lose some, or in the very worst case, all of your principal as well. So make sure you understand the risks and are comfortable with them. And as always, if you want to learn more about autocallables, return of capital, and other higher yielding income opportunities for the boost part of your portfolio, or perhaps how to build out the base part of your portfolio and create a safe, stable, and predictable income that lasts a lifetime, come on over and join our growing member community in our VIP investment club, where these conversations happen almost daily. Visit our website at www.diamondnestegg.com and click on this yellow private VIP investment club button to learn more and join us today. I've linked everything below for your convenience. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed this video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.